Welcome to Independent Wealth Planner Strategies with Jennifer Lang, helping pre-retirees and retirees build, preserve, and protect their financial assets in today's volatile market.
Sponsored by WFGInsuranceQuotes.com.
Welcome to today's webinar. I'm Mike Payne, and your host for today is Jennifer Lang. Jennifer is an author, a speaker, and a licensed financial services professional who found her love for financial literacy the hard way. Her career goals were on track as she tackled the hustle and bustle of working in New York City as a corporate manager. That is, until life threw her a curveball that would change her direction. Her mother became ill, and Jennifer only had one choice. She left New York and became her mother's full-time caregiver. It was during this 10-year period that Jennifer learned firsthand the importance of how life insurance protects an individual and a family while they are alive, as well as how having essential estate planning documents can empower family members and relieve burdens. She found a new passion and purpose to help the underserved middle class protect against the emotional, physical, and financial stresses of caring for their loved ones. Currently, she works with businesses and families in all 50 states to acquire business loans, life insurance, and annuities. She is contracted through One Resource Group, and you can contact her through her website, WFGInsuranceQuotes.com. So, without further ado, Jennifer, take it away.
Thanks, Mike. I'd like to welcome and thank everyone for attending today. My name's Jennifer Lang, and this webinar is being recorded and will be available for rebroadcast later on. So please submit all questions via our website. The chat is open, so tell me your name and where you're from, and I'll get to those questions as time allows. I see some familiar names in the chat box already. Hey, Bernadette, Jacob, good to see you. Charlie, hey, Carolyn, glad you made it, yeah. Thank all of you for joining. Today's webinar is entitled Protecting Your Retirement Income from Market Volatility, Annuity Basics. And as Mike mentioned, a person can either learn things the easy way or they can learn things the hard way. In my case, when my mom got sick, I learned the hard way. I, like most people, thought that life insurance was just something you had in order to pay for a funeral. I didn't know that there were certain policies that could actually help you while you're alive. So I do these webinars and I speak to businesses and organizations because I want to help as many people as I can reach their hopes and dreams and avoid that financial learning curve that I went through. And as a token of my appreciation, everyone on the webinar today will be given access to a free ebook that you can download after the call. I'm a part of an online educational program called SafeMoney.com, and I wanted you to have access to the information on this website right away because this has been a tremendous resource for people I'm working with. So, regardless of where you are in your retirement journey, you will find there are many helpful pieces on there. Now, let's jump in. The first question I'd like to ask is, when do you plan to retire? Seems like it would be an easy question to answer with a quick age-related response. Or as one guy put it, never. Or as this one lady said, as soon as I can, honey. In 2015, the National Association of Government-Defined Contribution Administrators chose 2 words to sum up the state of America's retirement funds. Those 2 words were not ready. Americans seem to agree. Only 22% surveyed said they feel confident they'll have enough money during retirement. In fact, the majority of working households with workers nearing retirement, age 55 to 64 years old, often had one worker with less than 1 year's income saved. The biggest challenge people will face is paying for their own health care. Only 1 in 6 employers offers their retirees health care, and there are plenty of expenses Medicare does not cover. Over the next 2 decades, the average 65-year-old couple can expect to fork out up to $220,000 for their health care. And trust me, that is no exaggeration. Mike mentioned I was my mother's full-time caregiver for 10 years. What he didn't tell you is that I didn't and I couldn't do it by myself. My mother required 24-hour care, and it took 2 people to manage her. So we had to pay for extra help to come in and help us. Cash, out of pocket. So my brother's savings took a hit, my savings took a hit, my mother's savings took a hit. My father was out there working every day, approaching 80 years old, and coming home and helping to take care of her at night. So let me tell you, when I learned about living benefits through life insurance policies and long-term care riders, I was like, man, if she had had a life insurance policy that could have taken care of these costs, that would have taken all of that financial weight off of us. But by the grace of God, we made it through. Because let me tell you, my mother was Superwoman in the flesh. And as we think about moving forward in life, bottom line, planning is going to be the most important key to your success and peace of mind. The things that we take for granted, like bathing and clothing ourselves, once you have to pay someone else to do it for you, that is going to add up, and it's going to add up quickly over time. So that's my real life lesson. And note to self, if you are in that sandwich generation or your children are in that sandwich generation, have the conversation and ask the hard question. If something happens to mom or dad and they need long-term care, how are we going to pay for it? And where is the money going to come from? Because Medicare does not pay for long-term care costs. I repeat, Medicare does not pay for long-term care costs. Medigap does not pay for long-term care costs. So then the question becomes, so who does? And the answer is Medicaid. Medicaid is the largest public source of funding for long-term care in the United States. Medicaid pays for nursing, home care for older people with low incomes and limited assets. And it pays for long-term care services at home and in the community. Who is eligible and what services are covered vary from state to state. And although I don't want this to turn into a long-term care webinar, it bears mentioning. For those who apply to Medicaid for payment of long-term care services, they have to meet both financial and functional eligibility criteria to qualify. The financial criteria often requires that recipients spend down their assets to become sufficiently needy to qualify. So in other words, you would have to go on public assistance. Got it? Okay. So don't forget to include long-term care riders on your cash value life insurance policies and annuities. Now, according to the National Institute on Retirement Security, the average U.S. household has saved only $2,500 for retirement. That's the average for all working age households. This amount goes up to $14,500 when looking only at households near retirement. Running out of money in retirement is a major concern among men and women alike. But because females tend to outlive their male counterparts, their chances of meeting this unwanted fate are even greater. In fact, 42% of women think they're at risk of depleting their nest eggs by the time they turn 80, according to a new study by Merrill Lynch and Age Wave. The question now is, are they making a big to-do about nothing, or are those fears likely to materialize? So what's on your mind? Are you happy with your current rate of return on your CDs, savings, or money market accounts? Are you concerned about outliving your retirement income? Do you want your income in retirement to be guaranteed for the rest of your life? Or would you like to protect your retirement money from market downturns today? Truth is, thinking about the worst case scenario can be a little scary. But it all starts with a strategy. It all starts with a plan. If you're in your 30s and 40s, you can look at accumulation products. But if you're 65 years old, you want to look at guaranteed income products. So let's take a look at some strategies that can help you start to prepare. There are many reasons for choosing retirement protection annuities and products. The most common reason many people use annuities is for channeling their savings into a regular income stream during retirement. Funds from Social Security and pensions may not be enough to allow you to live the lifestyle you want when you retire. Choosing a retirement protection annuity can give you an additional paycheck every month to supplement those other income sources, giving you the funds necessary to travel, pay your expenses each month, buy gifts for loved ones, and more. Before purchasing an annuity, it's important to know the fundamentals. Let's start with the basics. An annuity is a contract between a policyholder and an insurance company. You make premium payments. In exchange, the insurer provides certain contractual guarantees. These guarantees cover a variety of contract components, including income, interest rates, or withdrawals. Premium payments may be a one-time lump sum or a series of payments over time. The purpose of an annuity is to provide an annuitant with a steady retirement income stream. Except for immediate annuities, most annuities allow for tax-deferred money growth until they're withdrawn. Depending on the annuity type, you can start receiving income payments either immediately or at some point in the future. This difference is what distinguishes the two main categories of annuities, be they immediate or deferred annuities. An immediate annuity is also known as a single premium immediate annuity, or SPIA for short. With it, you make a premium payment, usually a one-time lump sum, and in exchange, you begin receiving income soon thereafter. Income payments begin no later than 12 months after the initial premium payment. Unlike an immediate annuity, a deferred annuity starts income payments many years after the initial premium payment. A deferred annuity has two parts or periods. During the first period, which is the accumulation period, the money you put into the annuity, less any applicable charges, earns interest. This growth is tax deferred as long as the money is left in the annuity. In some annuity contracts, there's a second period called the payout period. During this period, the insurance company pays income to you or to someone you choose. This is also called the distribution period. which in most cases you're able to choose how you want to distribute your annuity money. Examples include free withdrawals, annuitization, lifetime income withdrawals, or lump sum cash surrender. Here's a short video definition of an immediate annuity.
An immediate annuity would simply be an individual putting a lump sum of money away and then having a guaranteed stream of income immediately. What a neat idea. What a neat deal. I'm 71 years old, still going strong. As we all know, people are living longer these days, and to realize that this income would be guaranteed for the life of an individual, that is indeed a great, great advantage.
Two other annuity types are fixed annuities and variable annuities. Fixed annuities are insurance contracts which enable growth at a fixed, guaranteed interest rate. Once the initial growth period has passed, which is to say how long that first period is guaranteed for, the insurer may change the guaranteed rate depending on a number of factors. Unlike fixed annuities, variable annuities provide an optional investment feature. Premium payments may be allocated into stocks, mutual funds, bonds, or other asset classes. If you receive interest credits, premiums and the interest credits are reallocated into this portfolio for further dollar growth potential. However, since money growth is tied to portfolio growth, your principal and interest are at risk of decline should the investments in which money is allocated have a negative performance. The next short video will recap the types of annuities.
Annuity Basics. Anyone who has suffered a financial loss in the past few years needs to know that an annuity can be an important part of a solid retirement plan. That's because it can protect a portion of your retirement savings from market loss and help make sure some of your income lasts as long as you do. And with today's retirement realities, most new or soon-to-be retirees actually prefer protection over growth. In a recent study of baby boomers, when asked what features are most important in a financial product, their top 3 answers were protection against market loss, a guaranteed stream of income for life, and the ability to support a steady, predictable standard of living in retirement. Some annuities can provide all of those things. In fact, only annuities can offer the combination of principal protection and income for life. But let's start at the beginning. What exactly is an annuity? An annuity is an agreement between you and an insurance company. You give money to an insurance company, and in return, they give you a guarantee. With some annuities, that means guaranteed interest or guaranteed income in retirement for a set period of time, or, if you choose, for the rest of your life. In this way, it's similar to Social Security or a pension that you fund yourself. Think of it as part of your plan for guaranteed lifetime income. An annuity can do other things too. It can give your money the opportunity to grow tax-deferred. Some annuities can help protect your money from market risk. And annuities can also be customized with extra features known as riders that you can add for additional costs. Sort of like adding features to a new car. Some common riders include guaranteed lifetime income and the potential for increasing income in retirement to help protect against inflation. Keep in mind, all annuities involve insurance-related fees and charges, and because they're long-term contracts designed for retirement, there may also be fees or penalties for taking money out early, including surrender charges, and if you're under the age of 59 and a half, a 10% federal tax penalty, which means you may lose some of your principal in some instances. Different types of annuities are designed to do different things. If you want protection from market loss and the predictability of knowing exactly how much interest and income you'll receive, a fixed annuity may appeal to you. Fixed annuities earn steady or fixed interest for a specified period of time. They also protect your money from the drama of the stock market. If you want the safety of a fixed annuity with the potential for better long-term growth, a fixed index annuity may interest you. Fixed index annuities provide the same type of protection as traditional fixed annuities, along with the potential for higher interest based on positive changes in an external index, like the S&P 500. However, you are not actually participating in the market, and there are limits to how much interest you may earn. In other words, fixed index annuities offer the protection of a fixed annuity with more upside potential. Now, if you want the possibility of even greater returns, and you're willing to assume more risk than with fixed or fixed index annuities, then a variable annuity might be right for you. A variable annuity's growth is based primarily on your chosen investment allocations, so it offers more growth potential. It also carries risk because you're invested in the market, so you will experience both market ups and downs, and you could lose money. However, most people purchase optional riders to help reduce this risk. There are also investment fees associated with variable annuities that vary depending on your investment choices. Annuities generally have two phases. First, you're building up your retirement savings, which have the opportunity to grow tax-deferred through credited interest or investment returns. This is known as the accumulation phase. Then, you'll start receiving money from your annuity, helping you to live your retirement the way you want. This is known as the income phase, and of course you'll owe income tax on any taxable portion. So to summarize, an annuity is an insurance product that can protect a portion of your retirement savings and provide you with steady, some even increasing income in retirement for the rest of your life. Think of it as part of your plan for guaranteed lifetime income.
Overall, there are 5 types of annuities: immediate annuities, fixed annuities, fixed indexed annuities, variable annuities, and multi-year guarantee annuities. One side note, in regards to variable annuities are not protected against market losses. If you're looking for a place where you can invest money safely, you may want to consider other annuity products such as fixed annuities. Except for immediate annuities, most other annuities are deferred annuities. They may also differ in terms of whether they come with single or flexible premiums. With single premiums, you pay the insurance company only one payment for a single premium annuity, while you can make a series of payments into a flexible premium annuities. In a flexible premium contract, you pay as much premium as you want, whenever you want, within set limits. For a scheduled premium annuity, the contract spells out your payments and how often you must make them. Consumer benefits will vary from annuity to annuity, but in general, benefits will include conservative alternatives to volatile assets like stocks, diverse product selection for differing needs and goals, and then there's liquidity. And I know you've got the Susie Ormans of the world who say there is no liquidity in annuities, but that's just not true. While there are surrender penalties with annuities, many annuities allow penalty-free withdrawals of up to 10% access to your money without any type of penalty or surrender charge. There's a lot of liquidity involved. It basically depends on the type of contract you have. So make sure you address this point if you feel having access to your funds is a priority to you. But there are many contracts that allow annual penalty-free withdrawals. Another benefit of annuities is that they are backed by insurers with financial strength and claims paying ability. They offer guaranteed minimum interest rates, and annuities also offer tax deferral. Fixed annuities earn compound interest on a tax-deferred basis. So you get interest on interest on interest, just growing for you. For example, earnings on CDs, certificates of deposit, are taxable in the year the interest is earned, even if you don't take the money out. With fixed deferred annuities, earnings accumulate tax deferred and are not treated as taxable income until they are withdrawn, which gives you a measure of control over when you pay taxes. When saving for the long term, it may make good sense to rely on tax deferrals. Fixed deferred annuities may also help reduce or eliminate the taxes on Social Security benefits. By leaving your money in a fixed deferred annuity, You can reduce your taxable income, keeping it below the level where you would begin to owe taxes on your Social Security benefits. In contrast, since earnings in a CD are taxable in the year when earned, your interest earnings count in the calculation of how your Social Security benefits will be taxed. As much as 85% of your Social Security benefits could end up subject to taxation. When you're looking at market volatility, annuities give you principal security. You never lose your principal if your contract is held for the full term. So no matter what the stock market does, you are guaranteed income benefits, either for life or a set period. For example, if you're 65, about to retire, and the stock market takes a 20% drop, you just lost a big chunk of your nest egg with no time to get it back. So looking at an annuity gives you that principal security. Annuities are the only vehicle to offer a guaranteed lifetime income source in writing. And last I checked, the stock market doesn't hand out written guarantees that you'll never lose money. Annuities can offer a guaranteed death benefit subject to certain conditions, such as excessive withdrawals can reduce death benefit. There are options for increased interest linked to equity index gains. Index riders can be added for further benefit. And annuities avoid probate. Not everyone has a will or has done adequate estate planning, so the annuity would pass to your beneficiaries if named. There are numerous other advantages to annuities, but these can vary depending upon the annuity product you buy. Be sure to carefully examine all your options with a knowledgeable professional before a purchase. So the final question is, why use an annuity? And this video sums it up.
In retirement, you want to feel confident that your money will last as long as you do, and that it will help support the future you envision with the people you're responsible for. Including annuities as a part of your retirement income strategy can help. An annuity with lifetime income benefits helps provide a protected, dependable income that's safeguarded from market ups and downs and won't run out, no matter how long your retirement lasts. Annuities can help you feel more confident about maintaining the life you and your loved ones have built. In fact, 73% of people who own annuities feel more confident they'll be able to live the lifestyle they want in retirement compared to those who don't have one. And 7 in 10 annuity owners believe their savings and investments will last if they live to be 90 years old. An annuity can help replace your paycheck so you can support and enjoy this next chapter of your life. A financial advisor can help you create a diversified income strategy that fits your needs. And these lifetime income benefits can even be passed on to the next generation. This way, you can help continue protecting what's important to you, even in retirement.
A common misunderstanding of annuities is when someone dies, the money in their annuity goes to the insurance company, not their beneficiaries. This actually only applies to life-only immediate annuities with no certain period, or life-only single premium immediate annuities with no certain period. With a life-only single premium immediate annuity, people will be able to receive the highest income stream based on their life expectancy. However, when someone passes away, the remaining money will go to the insurance carrier. This only applies to a single premium immediate annuity with a life-only payout. Single premium immediate annuities offer an immediate income stream for the period that you desire. In most cases, you have access to only your income stream, not your principal, which can matter in emergencies. You're also locked into an interest rate between 1% and 3%, depending on when you purchased it. However, with fixed annuities, this is not the case. so be mindful of the types of annuities. A single premium immediate annuity will receive the highest income stream, but a fixed annuity will give you a guaranteed income stream and allow you to leave a death benefit to your beneficiaries. So let's take a look at how these payout options might affect you on a monthly basis. This is a client case study example. We've got Neil, and he's a 70-year-old male, and he's putting $250,000 into a single premium immediate annuity. If he chooses number 1, the cash refund option, he'll get monthly payments of $1,445.66. Upon his death, if there is money left from his initial premium, the difference will be paid to his beneficiary in a lump sum. If he chooses number 2, the life with period certain option, he'll get monthly payments of $1,568.77. If he dies before the end of the guaranteed period chosen, the guaranteed income will be paid to his beneficiary for the number of years remaining in the guarantee period. If he chooses number 3, the life-only option, he'll get monthly payments of $1,623.15. So he'll receive a guaranteed income for the rest of his life, and payments will cease upon his death. Conversely, here in the next example, let's look at how a fixed index annuity might look over a 30-year period. Let's say at the age of 55, Neil decided to get a deferred annuity. The values show what would happen if the indexed allocations earn 0 indexed interest and the fixed allocation earns the minimum annual fixed rate of 0.10% in all years. Neil would receive a protected income value of $305,000 with a guaranteed income of $15,250 a year. Then, if we look at number 2 and we take hypothetical values, looking back based on the most recent 10 calendar year period, here's how the index side of the annuity might look over a 30-year period with an increasing income rider that would allow him to keep pace with inflation. The values show what would happen if the indexed allocations earned indexed interest using current rates in all years. The indexed interest is based on actual index performance. Say, for example, if he chose the S&P 500 index during the most recent 10 calendar year period for the first 10 years. In all latter years, we repeat the index performance from the first 10-year period. So this is what could have happened if Neil had selected a 10-year deferred annuity with an increasing income rider when he was 55 years old. His protected income value would accumulate to $1,040,167 with a guaranteed income of $27,260 a year. So the guaranteed value in number 1 is the worst case scenario, and the index value is the best case scenario. To recap, you're going to first choose between immediate versus deferred annuities. And if you pay a lump sum and skip the accumulation period so that you can annuitize, and annuitize means to start receiving payments, you trade your paid premiums in the contract, that lump sum, you trade that for a guaranteed income stream for a set period, and that leaves no time for the cash value to grow. And based on how the annuity contract is set up, if there is a beneficiary payout option available, you select how it will be taken. Biggest takeaway from this point: the annuity contract is going to be administered exactly how it's set up. But bear in mind, if you choose a deferred annuity, You have to be committed to that growth period. All right. And I've got a question here from Gary in Texas. And Gary writes, "Hi, Jennifer." "Hi, Gary. How does life with period certain work for beneficiaries?" Good question, Gary. All right. For life with period certain, you choose a guaranteed number of payments, typically 10 or 20 years. Payments continue until you pass away and then are made to your heirs if there are years left in your period certain. Look at it this way. Let's say I'm 65 years old, and based on my health and my family history, I am certain I won't make it past 85 years old. Nobody in my family has, but just in case I do, I want to make sure I still have money to live on. So I choose life with a 20-year period certain. 65 plus 20 equals 85, right? Okay. Now, the annuity payments will still keep coming in, even if I make it to 90 years old. So I lived past that period certain. I only paid in enough money to cover 20 years, but I chose life with period certain. So the life insurance company paid that extra 5 years while I was alive. At that point, there is nothing left from the annuity for beneficiaries. However, let's say you've got enough in the annuity to cover you to 85 and you pass away at the age of 82. Then those 3 years of payments could then go to your beneficiaries if you have that option selected. Make sense? Great. At the end of the day, your annuity should be designed to take care of you or to take care of you and your spouse in your old age. Your cash value life insurance policy is what you keep to take care of your estate and your beneficiaries. 2 different vehicles for 2 different jobs. Got it? Excellent. All right, well, unfortunately, I'm limited by time. And as a token of my appreciation, everyone on the call will have access to our free ebook entitled Annuity Insights Guidebook. This way, you'll be able to grab a hold of topics I wasn't able to cover in this webinar. Simply log onto my website, independentwealthplanner.com, and scroll down to the ebook section. We actually have 3 books available right now. Feel free to download whatever booklet interests you most. I've been getting a lot of positive feedback about the 3 booklets. Since I am a member, there's never a cost to you. Just let them know I referred you. So where it says enter the name of the referring advisor, just type in Jennifer Lang and you can get the book for free. Also at my website, you'll be able to view articles, learn more about life insurance, retirement planning, and estate planning. And I see a question here from Troy about rolling your 401k over into an annuity. Okay, real quick, to answer your question, yes, you can roll over your IRA, 401k, 403b, or lump sum pension into an annuity tax-free. Annuities funded with an IRA or 401k rollover are qualified plans, enabling an insurance company to create what is called an IRA annuity into which you can deposit your retirement funds directly. But to avoid a tax bill, you would have your company make the transfer to the insurance company. Talk to me afterwards and I'll help you with that, okay? All right, and I'll make a note and I'll be sure to make that the subject of my next webinar. Sound good? Very good, very good. Well, until then, we have loads of information and content available for free on my website. Oh, you're welcome, Troy. That was a good question. It was a very good question. So, log on to my website, independentwealthplanner.com. It will save you a lot of time. You won't have to do Google searches for every topic. You can just make our website your go-to resource library for life insurance and retirement information. Of course, if you have any questions or would like to have a free financial needs analysis done, contact me via my website, independentwealthplanner.com, and I'll get your questions answered as soon as possible. Thank everyone for attending and have a great day. Until next time.
I've had this problem.
Big problem.
I really needed
a good insurance provider.
And I kept searching and searching.
There are so many choices.
It's really hard to find one that has all the things on my list.
But I finally did it.
Yes, yes, yes!
Thank you!
If you were looking for one as well, look no further.
Here's a really good one.
Just use mine.
Use mine.
I'm very satisfied.
Definitely recommend. Problem gone.
Thank you.